This is the year in which AGOA will come to an end, and African countries are lobbying for its renewal. What's on the line? 40,000 jobs and investment on the continent. Can we see a deal on paper or not? The questions we'll be examining from Washington, D.C. and Johannesburg, South Africa in the next 30 minutes, but there's plenty more in the pipeline. Here's what's coming up. Trading volumes at the NSE, they're down by over half so far this year. We'll tell you why. And poor investment strains innovation in Kenya's budding tech industry. Let's start today's bulletin on two continents. The African Union has started a fairly intensive lobbying campaign in Washington with a warning that hundreds of thousands of African jobs are at risk if the U.S. delays renewing the African Growth and Opportunities Act, better known as AGOA. Now, they want the American Congress to speed up the process of renewing the law, which provides preferential trade access for well over 35 African states. This, however, isn't just about Africa. As Daniel Rangers reports, one of the many beneficiaries of the trade pact are the manufacturers of one of America's most iconic products.
It's a product that's as American as apple pie. But among the 60 million pairs of jeans manufactured in the African kingdom of Lesotho each year, there are many stitched with the brand name Levi's. Lesotho's Trade and Industry Minister says 1 in every 45 jobs in Lesotho will be threatened if the US Congress doesn't renew the African Growth and Opportunity Act very soon.
If AGOA is not renewed in the next 2 months, at least before the end of March, the factories, the investors in Lesotho are likely to close shop, and we're likely to lose about 40,000 jobs. And that can be a disaster. It's a political instability. It is also a security instability.
The delegation has organised 15 separate meetings in Washington as part of the most determined US lobbying effort in the history of the African Union. AGOA supports 350,000 jobs directly and 1.3 million jobs indirectly in Africa, according to the AGOA Ambassadors Working Group. AGOA expires on October the 1st, but because businesses need to make purchasing decisions far in advance, the AU delegation says investors will walk away soon.
From what we were told, within weeks, not months, there's going to be something that's going to happen with AGOA as far as the bill. Until then, the bill is open. Some of us would like to see some enhancement to the bills.
The US wants to expand the list of eligible products for tariff-free import and enable more products to be imported, even if the manufacturing chain begins outside of Africa. The US agricultural lobby is also pushing for some reciprocal benefits, such as being able to sell chicken meat in South Africa. But the African Union delegation is urging lawmakers not to dwell too much on these details and, to put it frankly, hurry up or risk losing massive levels of investment in Africa. Daniel Rangers, CCTV, Washington.
And Daniel Rangers is in Washington right now with more details on that particular lobbying effort. Daniel, renewing AGOA, especially with the perspective of American politics, is this something that Republicans and Democrats both agree on, or is this likely to become another victim of partisan infighting on Capitol Hill?
It's absolutely a subject in which Democrats and Republicans not only agree upon, but work together upon. Now, I want to bring you some breaking news. I've just had a statement released from Senator Chris Coons. He was the head of the Africa subcommittee of the Senate Foreign Relations and has been integral with the negotiations with the African nations over AGOA and is a big proponent. Now, to give you some background, there had been some negotiations with South Africa. Many people who have contact with people on the Hill in the US Congress had said those negotiations had been going very well. They were encouraged that the US would be given some kind of market access to the South African chicken market. However, Senator Chris Coons has come out with a very strongly worded floor statement in which he lays down the gauntlet to the South Africans, essentially saying that sometime last year they'd negotiated hard, but that the South Africans have apparently thought that they could basically let those negotiations go. In fact, he says They apparently think they can continue to benefit from AGOA and shirk their most basic trade responsibilities. So the Americans are looking for the South Africans to lower their trade barriers to poultry. And what Senator Coons is now saying is that he will do everything in his power to block South Africa from AGOA if they do not move on this issue. Back to you.
Indeed, let's focus on something that you mentioned a little bit in your package. The EU made demands for reciprocal market access, and that was a very sore sticking point in talks with African states, especially when it came to economic partnership agreements last year. Based in part on the comments that we're seeing now from that senator, is Congress likely to demand similar reciprocity as part of an AGOA renewal package?
No, and the simple reason is because at the moment the US has too much bandwidth going on the Trans-Pacific Partnership with the Pacific nations and on the Transatlantic Partnership, which is between the US and Europe. So they're doing a lot of negotiations on that stuff. AGOA comes under a different set of WTO rules, World Trade Organization rules, which means that you cannot have reciprocal arrangements with those countries. That's not to say, however, that people like Chris Coons cannot then go to the South Africans and say, no matter what you say about AGOA, we won't let you into the club if you don't play by our rules on trade. So though the agreement on AGOA is set in stone, you cannot have a reciprocal arrangement. And the Republicans and Democrats are on side with most African nations continuing to receive that benefit. Nonetheless, they are willing at this time to play hardball with the South Africans.
Indeed, we'll have to leave it there for the time being. That's Daniel Rangers in Washington. He'll follow the developments on Capitol Hill with regard to AGOA's renewal. Now, on to South Africa. Earlier on Tuesday, Eskom said it would be raising power prices on the days when the system is expected to be under severe strain as part of efforts to cut demand. Now, this news came as the utility expanded scheduled blackouts with measures which aim to cut demand by at least 2 gigawatts compared to an earlier target of just 1. Now, the firm said blackouts are scheduled to remain until 10 p.m. local time on Tuesday from about 10:30 in the morning. Eskom spokesman Andrew Etzinger had earlier warned that there's a fairly good chance of more power cuts to come. South Africa is currently in what Eskom described as a stage 2 load shedding program. Stage 4, which is a lot worse, would see the company cut demand by 4 gigawatts, which is a lot. That's about 10% of capacity. But Etzinger said that this will be avoided unless it is absolutely necessary. About a quarter of Eskom's generation capacity at the moment is out due to technical problems. The head of the International Monetary Fund, Christine Lagarde, has warned that African economies could be hurt by a slowdown in China's economic growth and an imminent rate hike in the United States. While on a visit to Rwanda, Madame Lagarde said that the IMF's global economic forecasts have been revised downward over the last couple of months, despite an enormous fall in oil prices. She's still calling for vigilance right across African economies, saying that slower growth has implications for a continent that is now a lot more integrated into the global economy than ever before. Madame Lagarde said that the overall outlook for sub-Saharan Africa is still promising. GDP growth is being forecast at close to 5% on average, but growth forecasts for the region have been trimmed due to lower oil and commodity prices. Now, back to East Africa. Trading activity at the Nairobi Securities Exchange has been more or less cut in half so far in January, and stockbrokers we've spoken to attribute that decline to an ongoing dispute over the implementation of capital gains tax. Now, month on month, average weekly numbers of traded shares have fallen by more than half to just over 80 million. Despite a 34.5% rise in average weekly deal volumes, total equity turnover, that's also fallen by over 70% in January to an average of about $20 million a week from an average last year in December of about $69 million. After a 30-year break, capital gains tax was reintroduced in Kenya from the 1st of January this year. On the 26th of this month, the Kenyan Association of Stockbrokers and Investment Bankers formally challenged that tax in court. They're looking to have it suspended pending the determination of the case. As currently implemented, the Kenyan Revenue Authority makes stockbrokers responsible for not only assessing but also collecting capital gains tax, and not the actual buyers and sellers of equities and bonds. Let's get you some more details on what's going on in Kenya's equity markets. Amish Gupta is the Vice Chairman of the Stockbrokers and Investment Bankers Association. He's also the Investment Director at Standard Investment Bank. Thank you for your time this evening.
Thank you.
Really appreciate it. I understand there were talks before you guys went to court between the Kenya Association of Stockbrokers and Investment Bankers and KRA on the implementation of this tax, but those talks broke down. What went wrong? What happened?
Actually, it's quite the contrary. The talks haven't broken down. In fact, we'd like to thank the Kenya Revenue Authority actually for being proactive, for having had meetings, meeting different stakeholders, getting different views about the implementation of this particular tax. Let me say that dialogue is continuing. We are still in meetings on a weekly basis, and we're also providing information.
In fairness, though, shouldn't this have happened last year? I mean, they only put out the guidelines on the 8th of December, but the tax itself was supposed to start on the 1st of January.
Well, let's say this, that we were actually waiting for guidelines last year. We thought that these guidelines would give us a bit of clarity as to where we would be. Yes, they did come out in December. And let me say this, that actually we're saying that there are different types of marketable securities. So the guidelines actually are not just for securities that are actually listed, because there are other stakeholders involved generally for other marketable type securities, including bonds. The statistics you've given here today does not include what we think is the drop in volumes in the bond market as well for the month of January.
Yeah, we didn't cover bonds in that particular area. That was only for equities at the NSE. We also didn't cover OTC statistics as well.
Absolutely, yes.
Let's focus on the problems that you as stockbrokers have in implementing the tax, because for a lot of people who are not inside that industry, they won't understand what's going on. What's the problem in implementing it as per the guidelines that KRA has put out so far?
Well, what we're saying is that the first, I mean, we've identified more than 40 different types of challenges overall. But I think the key here is that just lifting a suspension on technical material that was in 1985 was really not the way that we were anticipating it. Basically, because we have become a very automated market, we are trading 3,000 transactions a day. Our view is that we're not in a position actually to be able to say that our systems can accommodate these at the moment. We haven't planned for this. We haven't actually got processes in place for this, and really we can't therefore play a role that we are expected to play, and therefore we don't feel that enough time has been given to discuss and agree on these matters.
Is it possible to put the infrastructure in place to actually enable brokers to act as tax collection agents? I mean, from a purely theoretical perspective.
I mean, it is challenging simply because of the fact that you can't actually also determine the cost price, and so for us it is actually very challenging.
So let me understand this right, because I remember that in the guidelines that came out on the 8th of December, KRA essentially said, for equities in particular, if it was bought before 2005, the highest price for any given share in that particular year will be assumed to be the price at which that equity was bought. Post 2005, we'd essentially use data from the Central Depositories and Settlement Corporation to determine the cost price. From that perspective, a layman would say that's fairly straightforward.
Actually, it's not. The way equities is bought and sold during a year, has been going on for many years. So actually, it doesn't mean that there's a simple scenario where shares have been purchased at a certain price, have been maintained all these years at a certain price, and therefore can be sold today at a certain price. So there are complexities involved. The data is not readily available. Shares have been bought even as far back as 1970s. So really, it is very challenging, and the data therefore cannot be relied upon in order to give the true capital gains. As a result, obviously, our view is that these are challenging amongst a host of other issues that we're addressing, and so we're hoping that this dialogue is going to continue, and that we will find a way forward.
Indeed, we'll have to leave it there for the time being, but thank you very much for your time this evening.
You're very welcome. Thank you.
Right, you've been speaking to Amish Gupta. He's the Vice Chairman of the Stockbrokers and Investment Bankers Association right here in the Kenyan capital, Nairobi. Let's take you to Johannesburg, South Africa now to give you a South African perspective of the efforts to, of course, get the African Growth and Opportunities Act renewed. Now, Sheena Mohammed joins us from the City of Gold, some would call it. Now, Sheena, from South Africa's perspective, are there aspects of AGOA which the country would like to be renewed, and if so, why?
Good evening to you. I think that's a very interesting question. The sentiment coming through from business leaders and economists in South Africa is really that AGOA was fine as it was. And this is an echo of the sentiment expressed by Minister Rob Davies sometime back when he told the US in exactly those words, that AGOA was fine as it was. And I think really the massive lobbying that we are seeing taking place right now is an acknowledgement from African leaders that AGOA is needed for Africa, judging from the economic benefits that have already flowed to African countries and that are yet to flow following the possible renewal of this important agreement.
Indeed. Let's focus on this dispute between South Africa and the United States over chicken exports from the Americans into the South African market. This was an enormous story last year. How close are we, at least from the South African side, to resolving that dispute?
Well, it's very encouraging to note that on this point of contention that discussions are taking place between South Africa and the US. And Minister Rob Davies did indicate that the US has warmed up to South Africa's willingness to make concessions. He is in discussion with the South African Poultry Association, and they are saying that they are willing to talk about making concessions, allowing access to the South African market when it comes to the export of chicken from the United States. And I think initially he did say he was very surprised about the threats coming from the US around this ban. But again, an acknowledgement about the importance of the South Africa's inclusion when it comes to AGOA.
Indeed, we'll have to leave it there for the time being. That's now Sheena Mohammed from Johannesburg. She'll keep following the story for us from the South African perspective. Quick run through equity markets here for you. One of those rare days when you have a clean set of positive numbers right across the board. The Nigerian Stock Exchange up by about a quarter, relatively flat here in Nairobi, up 0.07 percentage points. The strongest gain so far coming from Egypt, up by over 1%. Speaking of Egypt, we'll be there. They're making a bet on steel to drive future growth. Make hay while the sun still shines and oil prices are low. That at least is the argument being made by Mr. Biden. We'll tell you why shortly.
This is the first year that Africa will have more foreign direct investment than aid. And it's like the tipping point in terms of changing the way the continent is perceived. And I think this summit very much responds to that call. Now, whether it can materialize what is being announced is something that we'll have to check and see whether it happens.
Minutes into the hour, you're still watching Global Business Africa. Thank you for your time. Let's take it to Egypt. The country's economy, as you might be well aware, has been on the rocks ever since the overthrow of President Hosni Mubarak way back in 2011. Foreign investment flows have fallen. Domestic infrastructure projects are thin on the ground, for lack of a better word. That said, President Abdel Fattah el-Sisi's government has made infrastructure the linchpin of his policies moving forward. Now, with political and business leaders set to meet in Egypt in March for an investment conference, an Egyptian steel entrepreneur is now setting his sights and getting access to markets overseas.
At 1000 degrees Celsius, this furnace is helping to forge Egypt's economic development. The steel industry is heading for growth. The World Bank expects Egypt's real gross domestic product to grow 3.6% this year. And Egyptian Steel is one of the companies driving that growth. Its chairman and CEO, Ahmed Abu Hashima, thinks big changes are needed to overhaul the economy.
Egypt imports around $60 billion of goods per year and exports around $25 billion worth. This is a big gap which has caused inflation and currency deficit, and the dollar has kept rising. That is why we need to increase manufacturing in Egypt to reduce imports and increase exports.
The vast majority of his company's product is sold domestically, but Abu Hashima plans to export 20 to 30% of output in the coming years. He launched Egyptian Steel in 2010 with the backing of Gulf investors. Now, the entrepreneur's Alexandria plant produces 300,000 tons of steel roll per year. It's a key ingredient in Egyptian construction projects, large and small. 12 meters of steel bar is fed through a series of rollers and becomes 4 kilometers of steel roll, 6 millimeters in circumference. Once they've cooled, the rolls are packed onto lorries and taken to clients across Egypt. Abu Hashima says he knows the problems that must be tackled if his company is to continue to grow.
من أكبر التحديات عندنا في صناعة الحديد هي
One of the biggest challenges for the steel industry is energy. Energy is a problem in Egypt generally, and the shortage of gas and electricity and the lack of good planning during the last 30 years turned us from a country producing gas to a country with a gas shortage. This is lack of good planning.
بنحاول نتغلب على كل مشاكلنا.
But Abu Hashima hopes the Global Investment Conference to be held in March in Egypt will provide solutions to some of the challenges the industry faces. New infrastructure is key to Sisi's development plans, and the expansion of the Suez Canal is a mega project. But across Egypt, scores of smaller-scale building works can also be seen. Roads are being improved and bridges are springing up. And steel is an integral construction material, so the industry will almost certainly benefit. Egyptian Steel is already expanding. It's building a new plant in Beni Suef. Once finished, it will operate 24 hours a day and turn scrap steel into 830,000 tons of billet and 550 tons of rebar every year. It will employ 2,200 workers and provide even more jobs in transport and other off-site activities. A new plant is also planned for Ain Sokna on the Red Sea coast. Penina Karibe, CCTV.
Global oil prices, they're likely to remain relatively low for the next few years. Not my words, but that's according to the American Vice President, Joe Biden. He made those comments when speaking at the Caribbean Energy Summit on the 26th of January. And he added that it is time for countries to now invest in renewable energy as a substitute for fossil fuels. The summit was held in Washington. It included Caribbean area leaders, multilateral and development banks, as well as the U.S. Energy Secretary.
Let's start with oil prices, now under $50 a barrel. This gives governments a little space to breathe, and is likely it's going to remain relatively low for at least the near term, the next several years. There's an old saying, the best time to fix a roof is when the sun is shining. The best time to fix a roof is when the sun is shining. The sun is shining now, figuratively speaking. The time is now. Renewable energy is affordable.
Certainly in line with the comments of Mr. Biden there is making. Crude prices are still firmly below $49 a barrel. 48.19 is the latest number for Brent crude futures that we're tracking here for you. Gold, however, well above $1,200 an ounce, up by about 0.4 in trading earlier today. Similar gains being seen across the board with cocoa and coffee. We're back in East Africa next. We'll tell you how poor investment is straining the innovation in Kenya's tech industry. A journey to the Silicon Savannas coming up. Welcome back. Now, by some metrics, Kenya's tech scene is one of Africa's most advanced, powered by a combination of strong and fairly wide mobile phone usage, relatively cheap data tariffs, and a supportive, you could say, regulatory environment. That said, tech entrepreneurs do say that investment capital is relatively scarce because investors who were initially drawn to this Silicon Savannah are saying that there's a shortage of businesses they can invest in. On Grassroots tonight, here's CCTV's Leslie Murungu with the challenges and the opportunities in East Africa's largest economy.
The students at Red Rose Children's Center are embracing technology in a different way. Here, every student has a mobile phone installed with a learning app called Eneza. Eneza, which is a Swahili word for reach, has gotten a good response from the teachers who are now integrating it in their lessons.
The way we normally use them, we normally pick on a subject. After that, we pick on the challenging questions, then we work them on the board together with the pupils. So in case of any challenging question, we normally do them together as a class.
When, for example, you find your question wrong, they direct you and tell you the right answer and tell you more about the question.
Eneza Education, a startup, came up with the idea in 2013. Its founders say despite the inspiring uptake of the mobile application, funding still remains an issue.
The general idea of a startup is to make it so that it is self-sustaining. When you're starting a business, you want it to sort of fund itself. So, I mean, the initial funding that we got brought us this far. We have close to 350,000 students on the platform. But in the long term, we don't want to depend on funding.
Kenya boasts of mobile phone use of about 80% due to cheap data rates and a soaring smartphone uptake. But despite the favorable tech conditions, almost 70% of startups are not earning enough to maintain business. Lack of talent, problems in attaining seed capital, and ideas that cannot be sold to a mass market have so far held back hundreds of Kenyan startups.
I think a lot of things go into the success of startups. And any investor will tell you half of the startups will fail. So it comes from, first of all, maybe identifying the right gap into the market and creating the right solution to address that gap.
However much the seed capital and funding remain fundamental to the growth of startups, Mugethi Kitao believes that if an idea has capacity to solve a problem, then investment would not be a problem for innovators.
This is the first time that you're seeing a sector where young people can actually be empowered and not look to getting donors. This is a place where you're free to identify a problem and solve it, and if people like it, they can invest in it. It's the first time that we're not lagging behind the West in terms of skills and in terms of what we can do. So I'd like to encourage different players to come and invest in tech. Invest your money, invest your mentorship, and I would like to encourage young people to keep innovating.
African economies continue to expand rapidly. Safaricom, Kenya's largest mobile phone service operator, has launched the super-fast 4G internet, and 19 million Kenyans are expected to own smartphones by the end of 2017, proving that there is definitely hope for the tech industry startups in Kenya. Leslie Mirungu, CCTV.
All right, then a quick run through currencies here for you. Not much to talk about with regard to the trends that we've seen over the last couple of weeks. However, two things we're looking at. The Kenyan shilling still flirting around that 92 shillings to the dollar level, which was just below that earlier today. Some expected to hit 93. The Egyptian pound, of course, the machine gun devaluation still very much in progress over there. 743, the relevant number in the auctions this week. Will that change next week? We'll find out later on. But that's it for this edition of the program. Thank you so much for your time. As always, send your feedback on what we do around here. Global Business Africa at cctv.com is the email you can use. And of course, when we're not on air, Facebook, Twitter, YouTube, those are certainly your ports of call. We'll see you over there where the news continues 24/7. I'm Ramanya.